Good afternoon, everybody. What's going on? Whew. Anybody got any big Valentine's Day plans today? Anybody have a hot date tonight? No? Oh, good, Josh. I'm glad. Ah, having a cold's not great. You're gonna be at the chocolate sale tomorrow. I love it. I mean, the price of chocolate these days. You gotta be smart. All right. You guys got nothing but jokes. Ooh, that's interesting. Berkshire selling off some Apple for the first time. Oh wait, I can't talk about that yet. I got to do the disclosure. I'm an associate member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA/SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Position update. I got out of everything I was in yesterday. I got out of UVIXI, VXX, and I had gotten into Path as a small swing trade yesterday. Got back into it, I should say, and then I liquidated today on the up move. All right, so let's have a look. This market is incredibly strong. I can't with you guys and the jokes and the memes right now. So the SPYs here closed up a percentage point. The Qs closed up a little bit over a percentage point, and the IWM closed up 2.5%. They were down like 5% at one point yesterday, up 2.5% today. Is pretty sick. Is Apple moving on that? Yeah, Apple's down a couple bucks off that, and Tesla's ripping higher on this potential Elon Musk buy that we're seeing here. So Apple trading great. Whew. Okay, so let's talk about it. Really impressive day for the Bulls holding in as well as they did today. It really was not my expectation. You know, we talked about in the morning meeting that on the one hand, you've got this really strong daily chart still, and yesterday would just keep it simple, stupid, perfect technicals. Yesterday's low looks like a trend continuation low for the market for the SPYs and the Qs. The flip side of that is that on the small time frame, all three indices were still trading below the 8:30 high. So the small time frame is telling you that as long as we're beneath the 8:30 a.m. high from yesterday, the CPI high from yesterday, you can look to be short. The big time frame is telling you, hey, yesterday's pivot low with that afternoon rally is saying that we can get upside continuation. So you got these two different messages coming from the market that are competing with one another. When you have two different competing messages, the one that usually wins the war is the bigger time frame. The vast majority of the time, but not all the time, when you've got two sets of pieces of information that are different, a small time frame in this case that tells you look lower, and a big time frame that tells you look higher, usually the big time frame wins. The question is, could this time be different? And it just seems to me like there's so much information that's piling on right now that is potentially leaning towards the short side of that argument, even if it's always going to be the lower probability situation just from a technical analysis perspective. I just want to point out a couple of things here that came from Pat's note this morning that I thought were fairly significant. One was the volatility index, the VIX moving in conjunction with the S&P. I'm not sure, Pat, who did it? Those from Sentiment Trader? Yeah, so coming from Sentiment Trader, that is just one of many indicators that is indicating that the market should struggle to continue and could potentially have a pullback. You got an update on your CTA systematic traders in here, systematic funds in here, that over the course of the next 1 week, it's not huge numbers, but they're pretty much sellers in any tape. But on the 1 month, they're Buyers in a flat tape but very small. Buyers in an up tape but fairly small. Sellers in a down tape very big. So I think that overall this leans to the downside. Although this was also a really important chart on the CTA positioning in U.S. equities, because I remember I have continued to feel, and this is one of the things that we like to pay attention to, is overall positioning in the market for when it reaches extremes. I have still broadly felt that positioning, while it is starting to get to the point where it's you maybe can begin to look in the other direction, that it's not quite as extreme as it was in July, when, July, it just seemed like all the positioning information was really pointing towards that the market needed to pull back. I keep saying that this move here, while it's strong, positioning is definitely leaning more and more to that long side. It's working towards extreme. I keep feeling that we're not where we were in July. And the CTA positioning platform update chart, whatever you want to call it here, has us not quite there yet either. Getting pretty close to that July high, not at the extremes of what we saw in like 2021 at certain points, of course, which that was a unique time. But the highest point since July, but not quite over that line yet. So there's a bunch of stuff there that kind of says that we're getting close. That is all leaning towards the same thought process I've had from the beginning, which is, let's be less bullish up here, but not necessarily be bearish, because the uptrend is the uptrend and it's so important. The big difference maker, obviously, was just how important was that CPI yesterday. What does it change? Does it actually change anything? I know we had Goolsby or Goolsberg or whatever his name is, the Fed guy who actually can't vote in 2024, coming out with some extremely, I felt, dovish comments this morning, basically saying that this number doesn't matter, it doesn't really change our thought process, it's just one hiccup, kind of echoing the same things that Janet Yellen had said, where you can't pay attention to the month over month fluctuations every month. It has to be based on the bigger picture, and indicating that we still should see some cuts. But at the same time, we've been saying from the beginning that the market's been overpricing cuts. So I was inclined initially this morning to think, when we were looking at the big picture saying that we should be looking for upside continuation, versus the small picture saying, hey, you can still look to short as long as we're staying beneath the 830 high from yesterday. I was actually thinking that the small picture, which is the lower probability situation, technically was actually going to win out today, and that this gap up this morning was going to be something that gets sold. That obviously turned out to not be correct. We pretty much spent the entire day kind of digesting that gap for the SPYs, and then we closed really strong. Same deal for the Qs, and then pretty much the same deal for the IWM also, and though they began to grind up back towards $200, which it's, I know that the IWM is still below the 830 high. Let's take a look at that. Still a ways away from it, but this is impressive that the IWM is able to be back above that key 198.50 that we were just looking at a couple days ago. So it's an interesting environment. The SPYs still haven't fully proven themselves, so they've gotten very close. The IWM is still a couple dollars away, but again, it's impressive that they're able to be above 198.50, and the Qs are actually able to do it. They're actually able to close above the 830 high, which is just kind of mind-blowingly impressive. And I'll tell you what the real signal was for me today, that my initial pre-market thought process that the bear side would win out and that we would fill this gap, when I kind of knew that was wrong, was the second those SMCI 990 calls hit this morning. That the opening 990 calls, I don't remember what the size was, but it was on decent size. I don't know if you can find that quick enough, Pat, to be able to post it. But the second I saw that, I just kind of said, like, holy crap, this is not going to be done while they still are doing this gamma squeeze stuff. There it is. Wow, Pat, you are fast, man. You are so fast. 9:38 a.m. this morning. I swear, when I saw this hit at 9:38, I was like, the bear thesis is shot. And then at that point, even when I saw that, I was also thinking that my VIX idea was shot, that it wasn't going to be able to clear above the level that we were looking for and be able to give continuation. And then potentially that actually means that this whole market could continue to squeeze higher. So I liquidated my VIX positions. But yeah, SMCI bullish action February 16th. So this week, 990 calls for $252,000 opening. It's just like, oh my God, like who is buying this stuff now? But I remember saying that. I've said this in the past. It seems specific to semiconductors right now, but that type of bull flow, and we saw it repeatedly in SMCI. I think eventually we saw 1,000 call hits. Nvidia, the other ones as well. It does seem kind of confined to the semiconductor space, but it is starting to remind me of that like 2020 to 2021 bubble that we here all knew was a bubble, even though retail was continuing to buy and continuing to buy and continuing to buy, and probably them some of them are still bag holders in some of those BS growth tech companies from 98% higher than where some of those stocks are currently trading. It's starting to feel like that. But the flip side is when that flow is still coming in like that, you can't fight it. You just can't fight it. It's too powerful because you got a market maker on the other side of that who's selling those calls and is not going to want to be naked. So is just immediately trying to hedge him or herself out by buying the underlying in this SMCI and just driving this stock up. And it's very difficult to be on the other side of that. And I don't think that the market itself, honestly, you can have Apple be weaker or Tesla be weaker. You can have Jeff Bezos selling stock that's creating a little bit of Amazon weakness. I don't think that the rest of the Q names can roll over without the semiconductors doing it either. Therefore, it's just very difficult to be short this market while that bull flow is still coming into the semiconductors. And honestly, it's starting to become one of the bigger things that I'm paying attention to. I'm still wondering on the short side of the market, like the problem, and this is where I get myself into trouble sometimes, is that like I'm hitting a point where logically I just don't feel like the market belongs here, and I have to counterbalance my thought logic with just technicals, because again the technicals are just so strong, and we said it in yesterday's afternoon meeting that could be the pivot low that leads to trend continuation. But I'm wondering at this point if we just got to get through this options expiration this week, and then that maybe can loosen the market up a little bit. But pay attention to the continued bull flow in the semis and the rate at which it's coming in, and then also pay attention to it if at a certain point, if it not only stops but potentially flips, and that might be your real signal. And just trying to, I keep saying it over and over again, I don't hate the idea of trying to short this SMCI chart at all, to be honest with you, but you gotta do it right. You can't just be short even what you think is a small position. I'm just gonna short at $700 here, real small, $720 real small, because the stock is getting ridiculous and I'll build into it. There's a very real chance that those 990 calls hit, that this stock gets to $1,000 plus by the end of the week. I mean, it was just like a handful of trading sessions ago on an afternoon meeting when the thing was at like $700 or getting above $700, when I was like, we're seeing option flow at 8:30. Don't be surprised if it gets above 8:30. I'm right. Remember that? Which day was that? That might have been on the 9th that we saw the 8:30 bull flow come in. Similar to how today we saw 990 bull flow come in. And I remember looking at it and going, geez, is this thing really going to be able to get to 8:30? But also saying in my brain, don't count it out. When the bull flow is coming in like that, I've just seen it happen too many times now over the course of these last few years. And this is why the options data that we get into the VTF is so important and such a valuable tool to pay attention to. So I remember when Tesla was doing it, just totally just squeezing higher, just more and more bull flow, and you just did not want to come in on the other side of that trade. Again, I can't hate at all looking at this daily chart, looking at what's the RSI on the daily chart now, 99? I can't hate at all like looking for a signal on the small time frame to come in the other direction. But please, I've been saying it every day. If you're trying to short these insane semiconductors right now, short them on the way down, short them through a level versus a level, get stopped out when you're wrong, reassess, look for the next trigger. I don't care if you do it over and over and over and over and over again. If you execute well, even to the short side on some of this stuff, you could if you execute well to the short side of some of this stuff, you could get break even trades over and over and over again and eventually hit one, you know. And if you hit it, you still could look for a pullback to to $650 on this. To be totally honest, the stock has gone completely and utterly parabolic. But it was the same thing. You know, I came in this morning with this thought process in my head, and this is why you have to be mentally flexible. Of you know, I'm just gonna. I did a really good job trading yesterday to give myself some credit, and that set me up well for this morning. And I love how that works. Meaning, I was, you know, covering my shorts in the Qs on the way down, covering my semiconductor ETF shorts on the way down, also adding back to some of my longs on the way down. I get this big gap up this morning. I still think that this market's going to end up being guilty, at least in the small time frame, especially if we can't recapture that 830 high. So I'm like, okay, this is great. I'm just going to reshort my Qs, reshort my SOXL, and sell the equity stock that I had bought at, you know, SPY equivalent of whatever 491.50 yesterday into this gap up, and I'll get paid on it. And then again, it was literally once I saw that sweep hit at 938 where I was just like, this just can't be done yet. It's not over. It's not over. The market's not going to be able to pull. And then that was pretty much it. And then it turned into like a relatively boring day, but honestly, after yesterday, to be able to gap up and hold the gains, even if it was a boring day from an index perspective, you have to give that as a win for the bulls. Though the Qs being above the CPI high from yesterday is not enough for me. I need to see the SPYs and the IWM do it to really say, you know what, this short's not here. And honestly, even if that happens, part of me is still just going to credit that to this market squeeze that's occurring, which now is potentially a multifaceted squeeze. Where did the VIX close today? VIX closed under 15, yeah, 1440 or something like that, it looks like. I only have delayed quotes on that, but it looks like 1437 or something. So the VIX actually closed in an interesting area because I don't think it'll create as much of a squeeze necessarily in either direction, but if it does in any direction, it's probably going to be forcing equities to the upside here in the near term, which again could lead to some sort of blow off top. So, you know, I'm still trying to stick with my SOXL trade idea and my TQQQ trade idea for the moment. Being an SOXL, even though it's a levered ETF, has been significantly less stressful, I think, than trying to do it in some of these individual semi-names like an SMCI or NVIDIA. And I'm still up decent P&L in it from the way that I've traded it. So, going to stick with it for the moment. But have to recognize that this market actually could continue to squeeze higher throughout this week, especially if we still see the degree of bull flow today that we have seen, or if we continue to see the bull flow that we saw today continue, is what I'm trying to say. 10-day realized vol 68. I'm just looking at what Bill posted here, trying to understand it. What is HV? Historical vol. Got you. Okay. March. Gotcha. Thanks. Okay. 50K invested in March 500 calls on January 16th is worth $44 million in SMCI now. Yeah, nice. Um, all right, I'm trying to think about anything else to even talk about from today. It's really just all about the semiconductors and everything. And I honestly feel like my day ended at 9:38 when Pat posted that, and I was just taking a seat in the stands and just kind of watching at that point and trying to manage my swing positions because it doesn't seem like this market's done the way that that's coming in. But it I've also seen this before. We've seen this before. We've seen it in individual stocks. We saw it in the market as a whole in 2020, 2021. It's starting to hit the point in my mind, and I'm probably late to this thought process, which, if you look at the chart, that's a good thing, where we really are hitting just like a complete full-on bubble with some of this stuff. This is ridiculous where this SMCI is trading at this point. And like Brant said this morning, it's got a relatively short float, which I think a lot of us didn't realize this morning. I think Brant said 45 million shares or something like that, and it's been doing today it did 20 million shares, so doing almost half the float today, and it's been regularly doing that type of volume. They just continue to squeeze and squeeze this thing up with more flow, but it can't last forever, but it can last much longer than you expect, right? Markets can stay irrational for longer than you can remain solvent is one of the best things to remember. I still like to look at that JKS. Sometimes I need a reality check on trying to go the other way on a trade. That Jinko Solar move here was just so insane. I've gone over it in plenty of afternoon meetings. $22.75 up to $90 in just like a couple weeks of straight up. It's feeling a little bit. Look at this chart when you scroll out. This is stupid. But I'll tell you what else is stupid. Being short this thing from $700 without a stop loss is stupid, and that's just the way that the game is sometimes. But I think we'll be able to see it. The information, like I said in yesterday's afternoon meeting, is in the data. It's in the data. So, and our data right now, when it comes to this SMCI, is seeing that bull flow hit in real time and saying, "I'm not jumping in front of this train, no way." And then we'll take it from there. So I think for this SMCI, the way it's shaping up is that you got to get through this week. So if you're swinging some overnight and you decided to short some into the close, we won't say whose name in the VTF I'm looking at right now, but he's got a cool little symbol next to his name. It's the same deal. Be careful. You might be early. They could squeeze this thing to over $1,000 by the end of this week if that flow keeps hitting. And then there's a chance that part of me thinks that the short is until next week on this thing. And that they just could squeeze it, let's say Wednesday. They could easily squeeze this thing for 2 more days, get it to $1,000, $1,200, and then finally some sort of insane blow off top kind of comes into play when there's no liquidity left in the tape, and all of a sudden the flow changes or something with the options, and then it can go. So that's pretty much it. I closed out on my VIX positions. Being long VXX and UVIXY for more than a trade is not something that you want to do. So that was a trade that I needed immediate gratification in. I started to get it yesterday, but the rollover into the close, the market bounce into the close, the gap up this morning, it just wasn't there, and it's not a position that you want to sit in for a period of time to wait to see if you're right, which actually sucks about those products, because I feel like if they were a stock, I probably would have stuck with the trade a little bit longer to see if maybe I need to just get through kind of today and into next week a little bit. But I'm not holding VXX and UVIXY for days hoping that it begins to wake up. I'd rather miss the trade entirely, or again, a product like that, like I was doing yesterday, I want to buy it on the way up. I want to buy it on the way up. I want to buy it high. I want to sell it higher. And the game plan that I was looking for there, I was looking for massively outsized returns or nothing at all, and that was the exact game plan I followed. So closing out the positions, it pretty much ended up with nothing at all, and I am totally 100% fine with that. It's exactly what I game planned for. It's exactly what I wanted if I couldn't get the VIX to really move. Google getting hit. OpenAI develops web search product and challenge to Google. Thanks, Bill and Josh. Yeah, we're getting Google getting hit after hours. We're getting Apple getting hit after hours. So Apple bounced back a little bit. And Tesla's rallying after hours. I don't have anything else to say. I think that covers it. I got a hot day tonight, so happy to have this be a shorter afternoon meeting. But I'm also happy to answer any questions anybody has. So Rex is the first one I'm seeing. Disney had a time correction with its earnings. Okay, yeah, we looked at Disney this morning, and I think it was your idea. So Disney big gap up on earnings, 3 days of time correction. ADMA had almost caught up to the base, not quite there yet. Gave an inside day yesterday, but that inside day is impressive because it showed a lot of relative strength. It was able to close green yesterday when obviously the market had one of the worst days it's had in a long time. So very impressive relative strength. And then today you were looking for the inside and up for continuation, which I really liked the idea. The only thing that made me a little bit nervous is that the ADMA hadn't fully caught up yet. Which sometimes indicates that you get breakout failures. But the relative strength from yesterday, I thought, kind of countered that point. So let me read your question. So it had a time correction since its earnings. You traded it off the open when it broke through the inside day high. And then you added when Disney gave an inside 5 and up at 940. Okay? Right at the open, breaking highs. You're buying inside and up on the 940 candle. And then it failed. The market was also pivoting up at that time. At 9:55, the market's 5-minute ADMA caught up. Yep. Yeah, I feel like we've had the same I don't know if it's question or trade review with you where you had a very similar trade at one point recently that it was the same deal. You were buying the thing off the open, but the market wasn't ready yet. You needed the market to correct, have the ADMA catch up, and then it was like at 10 a.m. the pivot came into the market off the moving average and you were able to get your continuation in your stock. But before I come to conclusions, let me read the rest of your question. So 9:55, the market's 5-minute ADMA caught up and Disney pivoted off the 21 EMA on the 5 here. So I moved my stop to the low of the 9:55 candle. Sorry. And then the trade failed. And then Disney closed at a high today. That was just because of the market into the close. I found myself not doing very well on this type of day when the market is just done pivoting off the daily equilibrium. The second day, I usually am not trading very well and have a lot of time. Traded the stock, that stopped me out, and then closed at the highs. Could you talk about it and give a little bit more suggestion? Yeah, I don't know if I have a lot of feedback for you on that, honestly. I mean, it's really good that you were able to know yourself well enough to notice that you tend to be struggling on the day after potential pivots in the marketplace. So that's really interesting. I like how you traded it. I think that the concern I had about the ADMA not catching up to the daily, meaning that maybe it's not ready yet, just meant that the stock ended up trading a little bit more like the market today. I guess this was in some ways was relatively weak because Disney was able to go red. But if you just overlay an intraday chart of the SPYs on top of Disney, they look very similar, right? Making lows at the same time, closing on highs with the roundup. So you just got to be careful, and you can't know this ahead of time. Over trading and pushing for continuation on range days, because at the end of the day, even though we closed at highs, today was really a range day, and I do find that range days, traders who are looking for continuation, because it's the type of trader they are, can get hurt a little bit more. So that's why I do think that a really important key to your morning research every day is to try to figure out as best as you can whether today is more likely to be a range day or a continuation day in one direction or the other. And I'll be honest with you, I was caught flat-footed myself on it, at least initially, because I was not expecting it. If I had to try to predict probabilities in the morning meeting today, I feel like the last thing I would have said was that the market holds in all day and closes at highs. Um, After yesterday's trading session, that's kind of where my head was at. So, kind of given that context, it feels a little bit like you're fighting this range day, looking for continuation when Disney itself is not necessarily in play, and that's why you're kind of getting pushed around a little bit into your trading. The flip side of that is you can't. It's one of the more difficult things is to try to figure out whether or not the day is going to be a range day or a trend day before it even happens. So when you are placing those trades, it's hard to know that. I want to make the argument that the thing I don't like about your trade is that the market was against you, but the market wasn't really against you. It didn't go down, but it didn't really support your trade either. So I don't know. I don't really have great feedback for you, Rex, on this one, unfortunately. And I appreciate that you're always asking these questions, and I think most of the time I do. I kind of think that you traded it right. You were looking for a certain movement. You didn't get it. You stopped yourself out. It is what it is. And then yeah, don't let it get into your head that it closed on highs though. Um, I don't think that would have happened without the market. I don't think that would have traded independently to the market in such a way where if the market closed on lows or filled its gap and stayed weak during the day or had a range day but had it below 493 after filling the gap and going a little bit negative, I don't think that Disney would have closed on highs in that case. So I don't want you looking at it and being like, oh, my idea was right, my execution was wrong. I think that your execution was right and that the other factors cause it to fail, but those same factors kind of cause it to close at highs, if that makes any sense. I know it's a little bit of a convoluted answer, but it's the best I got for you, and I wouldn't beat yourself up on it. Just the biggest takeaway I think is that we want to do our best to try to figure out range days versus continuation days because the risk reward and what you're able to do and how active you should be is going to be different depending on that. And we can't always know with certainty, but we do our best to take our educated guesses. No problem. From Cameron, as markets change, some strategies seem to work better than others. How would you advise in understanding and adapting to these changes? More specifically, if I'm trading a strategy and it isn't working great, how do I know if this is just normal variability of a strategy or if the environment is not appropriate for the strategy? Hope to make the question make sense. Yeah, I think the question makes plenty of sense, and I think it's a very educated question. It's a great question. Without a doubt, certain market environments, certain strategies pay better than others. If you're in an uptrending environment, then breakout trades are going to work much, much better than if you're in a range-bound environment, right? So how do you know if you put on a series of trades over the course of a couple of days or a week or whatever, and it's not working out for you? How do you know if that's because the environment is changing or if it's just because of normal variability where you're working in a game of probabilities and sometimes trades don't work? That's the question. The answer is that, and this is like some of the difficult stuff about trading that we need to work on so hard every single day by doing tons of research, is that we as a team here are constantly trying to figure out what type of environment we're in, and we're also constantly trying to figure out if the environment is changing or in the process of changing. And that's been the big thing right now, right? We have just been in an environment here for 3.5 months where we've been going straight up. So what's worked in this environment? Trend continuation trades have worked. Breakout trades have generally worked. Those have been the best trades in this environment. And you want to stick with them for now. But right now, I think has been a time here where we have been looking at some data and some information, and we've been trying to ask ourselves, are we on the cusp of an environment change where this uptrend is going to not be able to continue? This uptrend is going to pull back. It's going to give a deeper pullback. The trend itself is going to break or just at least not continue by going into a range. So we've been looking at data now that has been saying, hey guys, maybe this environment is about to change, so let's be careful. Let's be more careful. That's what I've been advising, right? Be more careful on being outright bullish on your momentum longs and on your trend continuation longs, because yes, The bull trend is certainly there. That's what I keep wanting to emphasize. The pivot low from yesterday is still there. But there's a lot more evidence right now that we could be closer to a cusp of an environment change of this uptrend not being able to continue than I think at any other point over the course of the last 3.5 months. We could absolutely keep going for another week or two or year, for all I know. But that's the data that we're constantly paying attention to. So and that's what you're looking at, because you're basing your strategies around. I'm basing my strategies around that question. I was super gung ho, if everyone remembers, as recently as January here in the beginning of February, to say, hey everybody, go back and watch the afternoon meetings from these days. You'll see me saying, guys, we got to recognize these pivot lows. We have to make sure when they come in that we are, executing well, that we're getting our long swings on, because that's where the best risk reward comes from. Let's, really look into this pivot. I think it was a day early first, and then we caught it. Let's really look into this pivot for that low. And then if we can get the small time frame execution, you get a good close, keep your positions, look for continuation. That worked great here in the beginning of January. That worked even better. This was the easiest one on the January 17th low, where we had the intraday capitulation and meta that Pat called out and all those other names. Then right here, we were able to call the Fed sell-off. I think that was the Fed day, and then I don't remember honestly how, but we were able to call that there was a higher probability that this could immediately get retraced, and it's exactly what happened, which turned into the next pivot low, where you look for trend continuation. So what we're trying to do every day, and this is the hardest part of the job, you never really want to assume this time is going to be different, right? And that's why even into yesterday's low, even though I think verbally I'm so focused on the VIX trade and my QQQ short and the semiconductor short, because that's probably what's exciting right now of my portfolio. But at the same time, don't overlook the fact that into this pivot low yesterday, I was adding to all my longs. I was adding into all my longs yesterday. The difference right now, I think, is that we have a lot of evidence right now that is showing us that the market environment could be near the point of changing, and therefore I don't want to be as aggressive as I was on those call outs from the January 5th low, the January 17th low, and the January 31st low. So what you're asking is one of the most important parts, but one of the most difficult parts of successful trading and building that into your trading approach and strategies and game plans, is saying, hey, right now, yesterday through today, should I be looking for the same trend continuation trades that I've been looking for on these other days? Or should I be taking my foot off the gas pedal because there's evidence that's saying that maybe the market environment is changing, and therefore those same strategies that have just paid so well so far over the course of this calendar year, at least from an index perspective, might not work as well, might not be as profitable, might not be as high probability. And also, if it changes, what strategies should I be looking at into the new change, right? So yeah, I hope that helps. And I think that you want to assume that it is just normal variability until you have the evidence that the environment has actually changed, right? So we don't have that evidence that the environment has changed. We have a pivot low yesterday, we got continuation today. So you want to be sticking with your same trades, but at the same time, I think you could be looking at all the evidence that I've been talking about and saying, hey, maybe I shouldn't be putting on as much risk right now in my trend continuation trades, or as much risk right now in my breakout trades, because of the evidence that the environment is potentially changing. I hope that helps, Cameron. It was a fantastic, educated question. Zahora is already posted above. OpenAI is developing something to compete with Google search. Gabriel over in YouTube is happy about the IWM strength, but also conflicted that the semis are not giving up. Would I revisit the VIX trade? Yeah, I will definitely look to revisit the VIX trade. I think that trade is still in play. But like I said, that's a pure momentum trade. I need it to go right now. and it went yesterday and it failed, and these are not products that I want to sit in if it's not the time yet. So there's a chance that maybe this thing can begin to move this week, next week, and I think if it doesn't happen relatively soon, that's something that we can look at, mid-March, mid-April potentially, or as we're approaching options expiration again, maybe a little bit ahead of like the day before. But we'll pay attention to the data as it comes in front of us as we get closer to mid-March or mid-April. From Fernando in the VTF, could you share some rules that I can apply a day before economic events like the CPI? Sure. So you probably want to be extra careful about new swing positions the day before like a CPI. You probably want to be extra careful about taking on, new overnight risk right into a major economic event. Because you never know what the result of that economic event is going to be. You never know what the numbers are going to be, and you never know what the reaction of those numbers are going to be. So, if you were 2 days ago buying the SPY, and then you held it overnight, and then you got screwed on the CPI, I mean, kind of shame on you a little bit for that, because you knew that event was going to occur, and you probably should have been more risk averse going into it. Outside of that, you want to make sure that you have a good profit cushion, I think, going into major events like that on any positions that you currently are in, or you shouldn't be in them. Because if it's possible for that economic event to move the stock so much against you that you're in trouble, then you shouldn't be in it. I think it's different if, I don't know, let's say that you were still long, just using a simple example, if you were still long the market from January 17th as a swing position, and you're in from, $470, and you're $32 in the money going into the number, then you keep it, because who cares if this went down to 490 yesterday? You're still, it's not great, you don't want that, but you're still $20 in the money. It doesn't really matter. You're in a win-win situation. But don't let an economic event put you in a lose-lose situation where if you bought swings the day before the number and then it's going so much against you that you're in a bad spot. You can't allow that to happen. So that is the big thing that I would say going into the event. And then after the event, well, then you just trade the price action as it comes. So I hope that helps, Fernando. Roxanne, I started doing more options on the extension in the indices weeks out so that the impact is not too much and the risk is defined. I like that. On extension plays, you could probably do that on, into economic events also, where you are defining your risk a little bit more into these types of events by utilizing options. Thanks for the input there, Rock. That's great additional information, great additional thought process. All right, well, I'll wrap it up then. A little bit of a shorter afternoon meeting. We've had some good long ones recently, so that's good. Give me the thumbs up if you're in there on YouTube. Have a great night, everybody. If you're doing anything tonight, enjoy what you're doing, and I'll see you all tomorrow.